basically this entire move in the Nasdaq is being driven by like what top 7 companies. What does that mean? A lot of people are saying the breadth is low, like everything else is going down except these big companies. Nvidia's pulling the weight. What do you think about that? Is it possible that that means we're going lower? Because it seems like the Bears are really using that as an excuse for going lower.
I
But
think
I,
you,
I don't see it. I don't see it one
I,
bit.
I think what you have to understand with breath is it's cyclical, right? And this is not coming from someone that is uberly bearish or uberly bullish. We're not permanent market radar. We follow the models, we follow the data. So whatever the data says, whatever the models say is our viewpoint. So we're pretty agnostic when it comes to how we look at the market. And you can look at something as simple, excuse me, as if we take QQQ, right? And we we take the QQQ against the equal weight, right? So this is just a ratio of basically what it's showing you is it's showing you if you were to long QQQ and short the equal weighted version, meaning like every company in the ETF has the same weight instead of how it's market cap weighted right now, where a larger portion, a smaller number of stocks have a larger amount of weight. And you'll see here if we go back in time that this pretty much goes up over the long term, right? Like this is like it's not abnormal for the market weighted ETF to outperform the equal weighted ETF, showing you a concentration, which is essentially showing you a concentration of breadth. Now, to really make this simple to understand, think of it like if you have a basket of stocks, right? And in this case, we're going to look at the QQQ, which is the mega caps, right? And they're up there at all time highs now. At the last couple of weeks, they've been pretty new all time highs. And the argument is that there's a small number of stocks leading this move higher. Nvidia being one of them, uh, Microsoft, Meta, right? Well, typically it's the big names that get a premium for being good companies, right? And that's what we've seen in the last at least 15 years on the chart that I just showed you, how the mega caps get a premium over time. They just get bigger and bigger and bigger, or the market cap weighted ETF, right, grows at a faster pace than the equal weighted cap ETF. And the reason for that is there is always going to be a premium for a company that is almost guaranteed to print money, right? For example, Meta, Apple, Google, Amazon, even Nvidia. These are all companies that are like you don't have to worry about them
Yeah.
producing
And
profits.
it does become a self-fulfilling prophecy as well. That's why the momentum is so hard to kill. You don't really want to jump in front of that train. Definitely don't want to be
100%.
shorting them.
No, yeah, 100%. Dude, shorting is literally one of the worst investing techniques that any person new into the financial realm can do. It is literally probably it's equivalent to financial suicide,
Yeah,
shorting stocks.
there's no point in having a long short portfolio. We have thought about it. We've thought about making a long short portfolio, but at the end of the day, like there's if you're going short something, there is an equal and opposite thing that you can just long instead and have a better risk to reward ratio.
Typically, right now, I've seen firsthand some really successful long short portfolios executed. And I'm not going to sit here and shit on the idea of short selling, and like it doesn't work. It 100% does work, but the problem is it work short selling. You have to be extremely right on the timing factor of short selling, unless you're short selling a real dog of a company, right? Um, like if you're short selling Wish, right? Like that
Yeah.
thing just has gone straight down, right? And like these are things that are fundamentally broken companies, and you're shorting the failure of the business, right? You're not shorting because the stock's up too much. You're shorting because the business is fundamentally broken. That's a different thing. I can understand why people would take those shorts. That makes sense, right? But to shorten a video because it's gone up too much, that's not a valid reason to short a stock.
Yeah, and I think a lot of bears need to hear that.
I know. And like,
It's
look, some people win. Look, you can catch the top,
it's a
fade
very
it.
dangerous game to play.
It's a very dangerous game. Now, there are such things as like price exhaustion where things go up a lot and they can like consolidate, right? And they don't have to, like for example, here on the Qs, right? Price ripped and it consolidated. Someone that shorted up here, maybe they covered down here, they made some money. But even what you can tell with shorting on the way down, right? You have this there's this thing that is very well known, and then everyone knows what it's called a bear market rally, and it's very notorious, and it's something that pretty much everyone knows what that is compared to a bull market rally or a bull market dip. Those two do not have the same connotation as a bear market rally. The reason bear market rallies are known for what they are, or for being so popular, is because they're aggressive, rapid, and they're just forceful. So if you're short, it's a very different environment dealing with that type of positioning, because the downward move can stop and harshly move against you. Like I'm talking hard, because remember, over the long term, literally in the stock market over the long term, there is more buyers than sellers. So everyone, when stocks are coming down, especially indices, people are automatically going to start looking to buy the dip. That's just how it works, right? So you're fighting the passive flows. You're fighting people that just want to pick up some long-term allocations. And when the stocks start moving up, FOMO ignites real quick. And you're fighting a much greater tide than you are on the other side, which is why shorting stocks is just a very hard and not seen as a very successful strategy, where it's very easy to long the index. Like for example, you can just long the index. Odds are you long the index today, you come back in 5 years, you're going to be green. Odds are, right?
Yeah.
Odds are you short the index today and come back in 5 years, you will not be green.
Yeah.
So that's why shorting, you already fundamentally have odds stacked against you in the process. Now, a lot of people have made a lot of money shorting the markets, but the problem with shorting the markets, and let's just bring this down to another level, and a more psychological and holistic approach, right? You have to be a pessimist to short the stock market. To short anything, you have to be a pessimist. You have to be betting on failure. And there's perfect scenarios that make sense to bet on failure. For example, in 2008, you wanted to bet on the failure of banks because of poor subprime debt, whatever it may be, or credit, I mean, or if you want to bet on poor fundamental companies, like I said earlier, Wish has gone down significantly over the last 2 years. That's an example. That makes sense, right? But what ends up happening is, as you are right over time with shorting companies, and I've seen this firsthand, your confidence grows in your ability to predict the downfall of something else. And what ends up happening is your first approach is no longer, okay, is the market going to go up? Oh, your approach is the market's going to go higher, but how does this go down? It goes from that to, this is going to crash. You don't even consider the upside because you're like, this is overvalued. And what ends up happening is you are coming to the game fundamentally bearish, looking for reasons to be bullish, when it should be the other way around. You should always come to the market, no matter what. And however the market goes from here, even if the market goes down 20%, if the market goes up 20%, you should always come to the market. Your base case should always be bullish. Always. Specifically, and we'll talk about crypto later, but specifically in the stock market, always be bullish. That should be your starting point. Now, the next step is, could I be bearish? If so, prove to me it makes sense to be bearish, right? And the reason for that is the markets over time, we can just take a quick zoom out here, right? Over time, the stock market goes up over time. Yes, there's dips, right? Yes, there's bear periods, understandably. But over time, the stock market goes higher. So if the odds are the market's going to go up over time, that's where your base case should first reside in, and then you should have to disprove the reason why the market is not going to go up right now. That's where the bear thesis comes in. That's where having models and focusing on data is very important, because you can lean on the data and say, okay, the data is saying be bearish. I'm fundamentally bullish, but I need to take a step back and be bearish for the time being. Not the other way around, like bearish everything and then I'll be occasionally bullish here. That's not how most of those like Jim Chanos, all these people, their hedge funds end up imploding at some point, right? Because you cannot run a short fund without acknowledging the fact that you are fighting one of the hardest uphill battles there is, especially across the general market. So
Yeah.
let's take a step back now, or step forward, I should say, and move on to what's going on in the next week, right? So
Yeah,
we had
so
C.
let's talk about credit spread. So we did look at this chart. I think it was last week, last podcast. Basically, if we're above the green line, markets can head higher, and we are still there. Even though the market seems very overextended, that is not a reason to be short. That's not a reason to become bearish. Markets up too much. You got to realize that at the end of the day, we're only slightly higher than where we were before the inflationary recession that we had.
I want to make a statement here, and I think it's very important. Okay, especially for those that maybe are a little shaky in the market, or maybe they're just a little too pessimistic, right? Fundamentally, when it comes to looking at the stock market. In the last 2 years, you had mega caps. Okay, we're talking about Microsoft. Now you look at Microsoft today, you're like, oh, it's too high. Nvidia is too high, right? Everyone's screaming about Nvidia right now, at $700 a share. It's up. It's expensive.
It's probably going to hit a
Nvidia.
thousand. I think it's going to hit a thousand.
I mean, maybe, right? But like, we'll leave the semantics for the guessing for a different time, right? Nvidia was $100 a share in October of 2022. It's been a little. It hasn't even been 2 years since Nvidia was $100 a share. Nvidia fell, okay, from $300, $345. It fell 68%. Nvidia fell 68% in 2021 to 2022. So you have to take a step back and say, well, if we look at credit spreads, the market's just up too much. The market as a whole, we're talking mega cap names now. Obviously, Nvidia's blown up since then, right? But even Apple was down. Meta was down 60%, right? 50%. These are this is Mag 7 that we're talking about, right? 2 years ago, less than 2 years ago, down 30% over, at least across the board. They just had their bear market. Not to say that they can't go down again, right? But put this into perspective. They just priced in a recession that did not happen. They went worst case scenario. They thought the market took it like there was going to be a growth slowdown, inflation was going to be problematic, and the Fed was going to have to go a lot higher than they actually had to. And the market dove. Everything shit the bed. Bonds and stocks at the same time. Okay? That's obviously not the case. Market's reverting. Like you just said, we're just above the
Yeah,
prior all-time high
all we're
now.
seeing now is the reversion to the mean. That's basically what
Yes.
we're seeing now. A majority of this move is a reversion to the mean. Once we get to the mean and we keep moving higher, then it's possible to say, okay, we are starting to get overextended. But
Right.
where we came from and having 2 years of no movement, this is perfectly reasonable. We are going back to where we need to be, reverting back to the mean. That's all that's
Right.
going on right now. And there's definitely room to go higher.
And we came out with this term in the early stages of 2023 when the market was right around here on the chart, and we coined this term called false legends. And what that really means is there was a bunch of people that came up here and said equity markets look high, right? They got lucky. Some people were calling for a crash since June or May of 2021, and they were wrong all the way up, and then they finally were right. People started paying attention to them. There's a few people that have blown up on Twitter by actually calling the first half of the move wrong, but getting the second half right. So they made themselves look good. Long story short is they're a lot of these individuals are fundamentally bearish. They're perma bears. Okay, they gain a lot of attraction when the market goes down. That's how perma bears build their foundation. Most people want to be positive, right? They want to look at the things with the glass half full, not the glass half empty type of mentality. But when the market's going down, it's just red every day. People want to not experience that again. And there's these voices of reason that are floating around, these perma bears that are like, look, we said this was going to happen. We showed you guys. We told you guys it's all timestamp. And what ends up happening is you look at them and you say, man, maybe I should have seen this coming. They must have seen something I didn't. When in reality, odds are they didn't catch the top for the most part, right? And they grow in traction. They gain a lot of focus, especially when the market's going down, because it's apparent that people pay more attention to the market when it's going down than when it's going up, right? So you have a lot of eyes on you. and you're a perma bear by nature. So most of these accounts are not bullish today. They didn't even consider the possibility of being bullish at all yet so far, right? And what happens is they these drawdowns drag in new people into the perma bear cycle, people that maybe were long stock prior, and they become scared and they become perma bears themselves in the process. And that's a very dangerous thing. So you might look at the market at the lows and be like, oh, this guy called the move down perfectly. But in reality, they're just a false legend, because if you look at the grand scheme of things, the market goes up over time, and you end up sidelining yourself in the process because you're too scared to take initiative and to understand how cyclical and how just in general the regimes work in the market. And that's something that I want to emphasize, because there's a lot of people that shit on a lot of stuff that we talk about. Not us directly, but topics that we bring up is very hated on in the macro community, because they simply are pessimistic to the point where they miss the entire prerogative of what's going on, and they just want to focus on all the negative aspects. Like, for example, right, we can take a look here on the credit risk slide that we're showcasing. What this is telling you is there's a lot of bears still in the credit market. We're talking about the credit default swap market. Okay, we're not talking about the stock market. Credit default swap market. There's a lot of people that are still pessimistic on the outlook of the high yield market. Okay, and what this serves as is a gauge saying that there's still more bears than normal out there in the credit market. Does that mean that the market's guaranteed to not make a new all-time high? No, come on now. Don't be stupid, right? That's not how this works. The idea is this is just a guide. Out of a lot of things that we track, this is one thing that we tend to look at, and we made a graphical representation so you guys can see on a very clear scale that there is a premium in the risk space for credit in the credit market, showing you that people are still scared. So what does that mean for the market? Well, typically the market does not peak, at least historically over the last 10 to 12 years, unless this is pricing in complacency, which means this is below the green line. So there's just a little indication that there's still a lot of fear out there that has to get washed out. Do we get the washout before the market dips a little bit? That's debatable. But I do think that based on where we are right now and the consensus out there, that we're not going to see a material top in this market. I'm talking about a long-term high until we at least have a washout in the credit market, and we at least have some sort of full-blown consensus, like more signaling that people are completely long, because it's apparent that there's a lot of people that are not back in the markets yet, and they're kind of sidelined and FOMOing and whatnot. But it's really not showing you in the credit markets, at least, that we've exhausted ourselves to the upside, which is something we got to watch out for, obviously. But let's move on to
so
volatility.
I've got a question. So
Go
I think
ahead.
it's something that a lot of subscribers are thinking as well. So our Radar Quant fund, which has a 45% compounded annual growth rate, a lot of the holdings in our fund are at all-time highs right now, or
Okay.
close to it. What obviously these are for educational purposes. We cannot give advice, but I do know like that people will do what they're gonna do. Some people will follow it. We do not advise that, but some people will follow our models. For the people that do follow, new subscribers coming in that did not position when we positioned, and they're seeing these positions all at all-time highs, what's a good way to enter? Obviously, it depends on the person's risk tolerance. We don't know you guys. We don't know how old you are, your stage in life, how much money you have, how much risk you can take. But what are some strategies that people can do to enter in? Should people be sizing in? If what would you do if you were in that position where you come in late and you see the holdings where they are today, and you do want to get in on these models? What would you do?
So this is going to be a very it's going to sound very unprofessional, but I recommend obviously everyone manages their own risk. But myself, I would go completely in, 100%. If it was me personally, I would just go all in. Right now, you might say, "Oh, it doesn't make. Oh, what happens if the market dips?" Yes, the market can dip, sure, but the drawdowns, at least the way the model is the outputs of the model historically, the drawdowns are what the drawdowns are, right? So the drawdowns don't assume initial invested capital. It's just from peak to trough, right? So if the drawdowns are that on average, if the average drawdown is an X percentage, you have to be comfortable with that percentage, regardless if you buy today, buy tomorrow, buy on a dip, right? If you're not comfortable with that percentage, the average percentage of a drawdown that the model has shown, and remember, the drawdown can go well beyond the averages. These are just key markers. They're not absolutes, right? Things can be a lot worse or run up a lot more. Then you have to always manage your own situation. Okay, but for me at least, if I understand the average drawdown of the portfolio, the max drawdown, it essentially is if I'm afraid of drawing down that average drawdown, then I'm already in it too big, right? So like if I'm afraid of buying today because I might get that X% average drawdown from this point, then I've already played the game wrong. I already showed up to the game with too much baggage. Right. So that's something that you got to always pay attention to. Like if the portfolio drew down its average overnight, how would you feel? Would you feel heartbroken? Would you feel, oh my God, like my life's over? Then you've done something wrong. We're not talking about the max drawdown. We're talking about the average drawdown, right? The max drawdowns,
I somewhat disagree. I think you should go into it assuming the max drawdown can happen. So
no, 100%. You should agree that the max drawdown should happen. But I'm saying like the max drawdown typically is not going to happen overnight, right? Right. I'm saying like if you're going to go into this, I guess we're both saying the same thing, except I'm putting more of an emphasis on the average drawdown. You're saying the max drawdown, but I think that's probably a better angle to take. You're right. You should be comfortable with the max drawdown. If the max drawdown happens and you look at the scenario and you're like, oh my God, this is over for me. Like I'm so done. Then you've already played the game the wrong way.
Yeah, totally. I'm
right.
I'm in it. If we do hit the max drawdown tomorrow, I am in a position where I will still stick to the rules. I will not break the rules no matter what. The RQF has its rules. It's been tested. It goes back till 2016. That's it. I'm sticking to the rules because once you start breaking rules or bending rules, you really enter into a gray area. And that's where shit starts to go wrong once you're in that gray area. Because then it's like, okay, so you bent the rules this one time and it worked in your favor. Now that same situation is happening. You're bending the rules again, but now it's not working in your favor. What do? You kind of put yourself in that position where now it's like, okay, now you're making decisions based off of emotions. You're not making decisions based off of a proven strategy.
Right. And this goes back to, remember, these models are just guidelines. They're hypothetical. They're not designed for you to take action on them. Okay? But you have to manage your own risk. If you look at the max drawdown and again, the max drawdown can change. The max drawdown could be lower. Are the odds very high that it's going to make a new max drawdown? Probably not, right? But you have to assume that there's risk involved here. Understand what you're owning. Understand what you're buying, right? And then you can put that in context of how the max drawdowns happen. If you don't understand what you're doing, it's very easy to get lost in, for example, Aries, a segment of the RQF has 3 segments: Aries, Astrius, and Hercules. Aries is the long bond, long equity model. Astrius is the long Bitcoin model, and Hercules is the short volatility model. You have to assume that Bitcoin is going to have much higher volatility than equities. You have to assume that. So you have to assume that portion that's being allocated to Bitcoin could fluctuate at a much higher rate than the same portion allocated to equities. Now, obviously, the RQF allocates less to Bitcoin and more to equities, But you have to be conscious of the volatility of what you're buying, because the fluctuations in asset prices that you own create emotions, right? So like if things are going down and you own them, you get upset. If things are going up, you become euphoric. You have to try and minimize the emotions. Understand that price action will happen. Things will chop in between. You're here to play the longer term picture. So if you're not comfortable with a model that has the possibility of losing money, you should reevaluate where you can put that money, right? Because at the end of the day, these models are guidelines. Follow your risk, manage it, follow your risk profile that you've created for yourself, manage it, and execute it moving forward. Now, I want to speak about the final thing in this podcast is going to be, you can take, if it's just the S&P 500, right? We'll just take the S&P 500. You can buy the S&P 500. Anyone can buy the S&P 500, own it, draw it down 50%, right? That's a risk. Everything has drawdown risk. Everything that you buy. The only question is, does the model's drawdown control historically provide enough confidence to the point where it's not drawing down as much, as frequently, or providing outsized returns with similar drawdowns to make it worthwhile your time? Because otherwise, the passive index approach is always the backstop. If you can't beat the benchmark, you need to, I don't want to say you need to, if you can't beat the benchmark, you may want to just long the benchmark, right? If you can't beat the S&P 500, you may just want to long it. So the objective of these models are to keep within the profile of the S&P 500, which is our benchmark, provide X outsized returns to the upside while keeping similar, if not lower, downside characteristics than the benchmark has. So you're almost amplifying the returns of the benchmark without experiencing a lot of those negative effects that come along with just being long that benchmark. The problem is, again, these models, things can happen. These models may need to be changed in the future. They may need to be upgraded, modified, sharpened. That's how this works. Nothing is always going to be stagnant. You're not going to just set something, forget it for 20 years and, oh, great. Like, things are always evolving. So understand that as time goes on, things may have to change. Certain factors may have to be adjusted, but that's what we do. We sit here, we watch everything like a hawk. We adjust things. We move the chains forward. And that's why we provide these models as guidelines. You guys, it's your job to manage your own risk, look at them, follow them with caution. And obviously, every day is a day by day, or every day in the markets is to be taken day by day. And as we progress through them, things will slowly change. Some will change faster than others, but it's a building block process. And the whole point here, for us at least, when we do this for ourselves, is to compound returns massively and get off the grid. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on Twitter at The Market Radar, or go to our website at market-radar.com.